In 1929, Joseph Kennedy walked away from a roaring stock market months before it collapsed, and then made a fortune as it plunged. In 2008, Michael Burry stared at loan data no one else bothered to read, placed trades everyone mocked, and ended up hundreds of millions ahead when the system blew apart. Today, in 2025, the same signals are flashing again, the same behaviors, the same strategic positioning, the same four-stage sequence that always appears right before a major crash. This isn't superstition, it isn't luck, and it isn't hindsight bias. It's a repeating pattern that shows up every time markets hit extreme valuations, and only a small group of investors recognizes it early enough to use it. While ordinary people keep buying the top, convinced the boom will last, the smart money quietly shifts into a completely different playbook. And once you understand that playbook, the sequence Kennedy used, Burry used, and elite investors are using right now, you'll see exactly where we are in the cycle. What looks like chaos to most investors is actually a sequence, a precise, repeatable cycle that the smartest players follow long before the headlines catch up. Every major crash in the last century has unfolded through the same four stages. Stage 1, exit while everything still looks perfect. Stage 2, load up on protection while volatility is cheap. Stage 3, target the weakest sectors before the avalanche starts. Stage 4, buy aggressively when panic is absolute. That's the entire pattern. Not complicated, not mystical, just a disciplined framework that turns crises into opportunity. The reason most people never benefit from it is simple. They only notice the pattern when it's already too late. But once you recognize the sequence, the rhythm behind every major collapse, you can read the present the same way Kennedy read 1929 and Burry read 2005. And now we're going to walk through each stage, starting with the one that sets everything else in motion. Stage 1 always starts the same way. The smart money leaves the party long before anyone realizes the music is about to stop. And in 1929, Joseph Kennedy was the clearest example of that discipline. By the late Roaring '20s, Kennedy controlled enormous positions across the market. Prices kept rising, optimism was everywhere, and ordinary investors were piling in with borrowed money, up to 90% margin debt in some cases. To most people, it looked like infinite prosperity. To Kennedy, it looked like a trap waiting to spring. He understood leverage better than anyone. He knew that if stocks dropped even 10%, over-leveraged buyers would be forced to liquidate, which would trigger more selling, which would trigger more margin calls, a chain reaction that would feed on itself. So through the summer of 1929, he quietly unwound positions, not dramatically, not all at once, strategically, methodically, while the crowd was still euphoric. Bernard Baruch, another veteran of earlier panics, did the same. Both men stepped aside before the peak on September 3rd, 7 weeks before Black Thursday detonated the entire market. Stage 1 isn't about predicting the day of the crash. It's about recognizing when risk has flipped upside down and acting before anyone else understands why. 76 years after Kennedy stepped aside from a euphoric market, Michael Burry found himself staring at a different bubble, one hidden behind the polished ratings of Wall Street. But just like Kennedy, he recognized Stage 1 long before anyone else did. In 2005, Burry got access to something most investors never see: the raw loan data inside subprime mortgage bonds. Not the sales pitch, not the glossy A+A labels, the actual credit profiles of the borrowers. And what he saw was madness disguised as stability. Adjustable rate mortgages sold to people who couldn't afford the reset, no documentation loans, teaser rates engineered to implode. It was a structure built to fail. Burry didn't know the exact timing of the collapse. He didn't have to. He only needed to know that the risk and the reward had inverted. Exactly the condition that triggers Stage 1. So he pivoted early. He exited the consensus long position in housing and began constructing the trade that would define the 2008 crisis. Credit default swaps on the very bonds everyone else believed were bulletproof. John Paulson made the same calculation in 2006. He studied valuations, lending standards, and household incomes, and saw a bubble so stretched that it could only end one way. Both men endured ridicule, redemptions, and months of losses. But like Kennedy in 1929, they made the difficult choice early, because Stage 1 always rewards those who move before the crowd realizes why. If Stage 1 is the quiet exit before the storm, then 2025 is the loudest quiet exit in modern history, because the biggest players are already walking away. Start with Warren Buffett. Berkshire Hathaway is sitting on over $325 billion in cash, the largest cash position ever held by a private investor. When asked why he isn't buying, Buffett gave the simplest possible answer: nothing is priced attractively. Translated from Buffett speak, valuations are dangerously stretched, and risk is no longer worth the reward. he isn't alone. Jeff Bezos has offloaded more than $13 billion in Amazon stock across 2024 to 2025. Mark Zuckerberg has sold billions in Meta shares, even while the market was celebrating new highs. Jamie Dimon sold JP Morgan stock for the first time in his career as CEO. Across corporate America, insider selling has surged to levels not seen since 2007, the final year before the housing bubble imploded. Insiders aren't emotional. They see internal forecasts, real demand, actual revenue, hiring freezes, slowing pipelines, data the public only discovers months later. And when that cohort sells aggressively into a rising market, it's not a coincidence. It's stage one in motion. Add to that the Buffett indicator at 180% plus, far beyond the danger threshold Buffett himself set at 120%, and the signal becomes unmistakable. Just like 1929 and 2006, the smart money is stepping aside early, because stage two is always built on the discipline of stage one. If stage one is the disciplined exit, stage two is the move that separates professionals from everyone else. Because in stage two, the smart money does something most investors never even consider. They pay for protection while markets still look stable. In 1929, that protection came in the form of short positions. After Kennedy and Baruch moved to cash, they began borrowing shares and selling them into strength, paying borrowing costs, watching prices rise, absorbing the discomfort. But when the market cracked, those positions didn't just work. They exploded. As the Dow unraveled from 381 down to 41, the insurance paid out in multiples. In 2005 to 2007, Burry and Paulson reinvented volatility insurance. They spent years paying premiums on credit default swaps that looked pointless to everyone else. Month after month, they appeared wrong, bleeding cash while the housing market roared upward. But when defaults began climbing, those same swaps turned into the greatest asymmetric trades of the century, generating billions. And in 2020, Bill Ackman executed the cleanest stage two in modern history. He spent $27 million on corporate bond insurance just weeks before the COVID meltdown. When panic hit, the position paid $2.6 billion, a 96-to-1 return. That is the essence of stage two. You don't buy insurance when the fire truck arrives. You buy it when the neighborhood still looks quiet, because the moment the sirens start, it's already too late. Stage two is never loud. There are no headlines, no dramatic announcements, just a subtle shift in the derivatives market, the kind only professionals notice. And right now, that shift is unmistakable. The put-to-call ratio has spent months elevated above its normal range. When more puts than calls are bought, it means one thing. Institutions are hedging, not speculating. They're not betting on AI or soft landings or new highs. They're buying protection. VIX options tell the same story. Large blocks of VIX calls expiring in mid and late 2025 have appeared. Trades that only pay if volatility spikes violently. Retail traders don't buy multi-million-dollar VIX structures. Hedge funds do. Then there's credit. The cost of insuring commercial mortgage-backed securities has surged 300 to 500% since 2021. That's not noise. That's a professional class looking at empty office towers, refinancing cliffs, and math that simply doesn't work, and positioning for defaults. Even Bill Ackman has hinted publicly that he's adding protections similar to his legendary 2020 hedge. He doesn't broadcast specifics, stage two never is. But when someone with his track record starts talking about hedging, he's not theorizing, he's already positioned. Stage one was the exit, stage two is the insurance, and stage three, the aggressive targeting of weak sectors, is already forming beneath the surface. Stage three is where subtle positioning ends, and surgical targeting begins. This is the moment when the smartest investors stop merely hedging and start betting directly against the weakest structures in the system. In 2008, this was the stage that minted the biggest fortunes. Burry didn't just bet against housing, he dissected mortgage pools loan by loan and found the exact tranches guaranteed to fail. Subprime borrowers in overheated states, adjustable rate loans set to reset, no income verification mortgages built on fantasy. He shorted those tranches specifically, the financial equivalent of removing the precise bricks holding up a collapsing wall. John Paulson went even further. He didn't short financial stocks. He shorted the ones whose balance sheets were ticking bombs. Lehman Brothers, Bear Stearns, Washington Mutual. Wall Street analysts rated them buys. Paulson saw insolvency hiding beneath the facade, and he positioned accordingly. Their stage three trades didn't pay because the market fell. They paid because the right parts of the market fell first and hardest. Stage three is always the most aggressive phase, the one where conviction matters more than consensus. It requires identifying exactly where the structural failure will begin. And and stepping into the trade before the cracks become headlines. And in 2025, those cracks are already visible, starting with the sector no one wants to acknowledge is in freefall. If there is one sector already buckling under its own weight, it's commercial real estate. And Stage 3 investors have zeroed in on it with absolute precision. Across major U.S. cities, office vacancies sit at 40 to 50%. What used to be 5 full floors leased by a single company is now 2, sometimes 1. Remote and hybrid work aren't trends, they're structural shifts. And the buildings built for yesterday's economy simply don't generate the cash flow to survive today's interest rates. Most of these properties were financed when money cost 3%. Those loans are now expiring. Refinancing happens at 7 to 9%. For thousands of buildings, that math is fatal. A property that barely covered debt service at 3% is outright insolvent at 8%. Values have already dropped 40 to 60% in many markets, and the real stress hasn't even started. More than $2 trillion in commercial mortgages must be refinanced in 2025 to 2026. Defaults aren't a possibility, they're a schedule. We've already seen the preview. Brookfield, one of the world's largest real estate owners, simply walked away from 2 Los Angeles towers. Not because the firm was failing, but because the buildings were worth less than the debt attached to them. Hedge funds see the same math. That's why short interest in commercial mortgage-backed securities has exploded. Stage 3 players aren't guessing. They're targeting the collapse at its most vulnerable point. And the next domino in this chain is even weaker: the regional banks holding these loans. If commercial real estate is the spark, regional banks are the dry forest waiting to ignite. And Stage 3 investors know it. America's largest banks, JP Morgan, Bank of America, Wells Fargo, have diversified portfolios. Commercial real estate is a footnote, but for regional banks, it's the core of the business. 20, 30, sometimes 40% of their loan books are tied directly to office towers, retail complexes, and properties now worth a fraction of their original valuations. That's why the failures we saw in 2023 and 2024 weren't random. Silicon Valley Bank, Signature Bank, First Republic, New York, Community Bank. These collapses were early tremors, not the earthquake. Here's the real issue. When office buildings default, the loss doesn't hit the tenant or the landlord or the developer first. It hits the bank that issued the loan. And once the value of the collateral falls below the value of the mortgage, the bank must recognize losses large enough to wipe out its regulatory capital. Short sellers aren't guessing which banks are exposed. Banks publicly report their loan compositions every quarter. Hedge funds can see exactly which ones are sitting on the worst combination of high vacancy markets and high CRE concentration. Short interest in many regional banks has surged accordingly. They're not betting on panic, they're betting on arithmetic. Stage 3 is now fully formed. CRE is cracking, regional banks are next, and the chain reaction is inevitable. Stage 4 is where everything flips. It's the moment when the crash has already destroyed the majority of investors, and the small group who executed stages 1 through 3 steps back in with precision. The Great Depression wasn't a quick drop. It was a 3-year freefall, from 381 in 1929 to 41 in 1932, an 89% collapse. Most investors didn't just lose money, they were wiped out. Margin debt vaporized portfolios. Businesses failed, banks collapsed, confidence evaporated. But Kennedy and Baruch, the same men who exited early, were waiting exactly for this moment. They redeployed their cash into the panic, buying stocks trading below the cash they held, acquiring businesses being liquidated for pennies, purchasing real estate from distressed sellers who had no other options. They weren't gambling. They were executing Stage 4, the phase that transforms a correct prediction into generational wealth. By the mid-1930s, Kennedy wasn't simply wealthier. He was one of the richest men in America. Not because he timed the crash perfectly, but because he knew when to step back in. Stage 4 is never about bravery. It's about preparation. And the same dynamic played out again in 2008 and 2020. If 1929 showed how Stage 4 creates dynasties, then 2008 and 2020 proved the pattern wasn't a historical anomaly. It's the operating manual of the modern financial elite. In 2008, fear was absolute. Lehman had collapsed. AIG was on life support. Banks were failing weekly. Analysts openly speculated about a second Great Depression. And that's when Warren Buffett stepped in. He didn't buy hype stocks or chase volatility. He negotiated deals that only appeared during full-scale panic. $5 billion into Goldman Sachs preferred shares paying a 10% annual dividend. Warrants that gave Berkshire the right to buy stock at fire sale prices. Similar terms with Bank of America a few years later. One decision, made when everyone else was terrified, generated tens of billions over the next decade. Then came 2020, the fastest crash in U.S. market history. While commentators debated whether capitalism was collapsing, Bill Ackman played both sides of stage 4 flawlessly. His $27 million insurance bet had just paid out $2.6 billion. And while his now famous Hell is Coming interview sent markets tumbling further, his fund was simultaneously buying Starbucks, Hilton, Lowe's, and other companies crushed by panic but structurally sound. 3 months later, after unprecedented stimulus, markets rebounded violently, and Ackman recorded the best performance of his career. That's stage 4. You don't buy the collapse. You buy after it has shredded every weak hand in the market, and that moment is forming again, right in front of us. Every crash has a moment when fear becomes unbearable, when selling turns into capitulation, when logic dissolves, when even strong companies trade like they're going bankrupt. That's the real beginning of stage 4. And all evidence suggests that 2025 to 2026 is shaping up exactly for that moment. Here's the setup. Commercial real estate is breaking under refinancing pressure. Regional banks, the ones holding those loans, are seeing rising short interest and weakening balance sheets. Insider selling is at pre-2008 levels. The Buffett indicator hasn't been this stretched since the dot-com peak, and the yield curve, which has predicted every recession since the 1950s, inverted, then normalized, the most reliable pre-crash signal of all. That's the foundation of stage 4, a system strained at multiple points, waiting for a single catalyst. When that catalyst appears, whether it's a wave of CRE defaults, a regional banking cluster failure, a geopolitical shock, or a liquidity freeze in credit markets, markets won't drift lower. They'll air pocket, just like 2008 and 2020. That's when the smart money deploys the capital they've been hoarding. Buffett's $325 billion isn't idle. Private equity's record levels of dry powder aren't accidental. Hedge funds aren't building insurance and targeted shorts for fun. They're waiting for the moment when quality companies trade at 40 to 60% discounts, because that's what stage 4 always delivers. The only remaining question is who will be ready to act when it arrives. The 4-stage pattern isn't theory, it isn't hindsight, it isn't a clever narrative stitched together after the fact. It's the most consistent cycle in financial history, 1929, 2008, 2020, and now again in 2025. And right now, we're past stage 2, deep into stage 3. The cracks are visible. The players have positioned. The timeline is unfolding exactly as it has every time the system overstretched itself. The question isn't whether stage 4 is coming. History says it always comes. The question is whether you'll be in the group holding cash, protection, and a buying list, or in the group watching their portfolio melt while promising themselves they'll buy when it dips a little more. So here's what you can do right now, without trying to be Kennedy, Burry, or Buffett. Hold more cash than usual, not forever, for opportunity. Consider basic protection. Even small hedges can change everything in a crash. Build your list of companies you'd buy at 40 to 60% discounts before fear makes rational thought impossible. Follow the signals. They're not subtle anymore. Stage 4 creates the biggest wealth transfers in modern markets. Some people get crushed by it. A very small group positions early and steps in when everyone else is paralyzed. The pattern is clear. The timeline is visible. The window is narrowing. When stage 4 hits, and it will, you'll either be prepared to act, or you'll be one more casualty of a cycle as old as markets themselves.